Hello everyone, welcome back to Let's Learn. So if you are new to this channel, please subscribe to the channel and click the bell icon to get the latest notification. So today we are going to discuss primary market instruments. Okay, this is one of my favorite topics and it is a very simple and easy topic. Okay, so today in this video we will be covering the major four primary instruments. Okay, that is equity shares, preference shares, debentures and bonds. Okay, so let's start the video. So the first one is equity share. So what are the equity shares or who are the equity shareholders? Equity shareholders are the ultimate owners of a company. Okay, they are the risk bearer of a company. So as they are the risk bearer and the ultimate owner, these shareholders do not carry any preferential right in respect of dividend or repayment of capital. Okay, their dividend is paid only after payment of a fixed rate of dividend to the preferential shareholders. And by this, the dividend of the shareholders always vary according to the profit earned by the company. So equity shareholders are paid at last at the time of winding up of a company. That is, if a company is winding up, the company will pay off every others like debentures, preference shares, debtors, and the equity shareholders are the last one to be paid at the time of winding up. But what are the benefits of equity shareholders? As they are the ultimate owners of a company, they do have their voting rights and decision making rights. Okay, so these are the features of an equity share. So let's see what are the classification or types of equity shares. Okay, so the first type of equity share is blue chip shares. So what are blue chip shares? Shares issued by blue chip companies is known as blue chip shares. So what are blue chip companies? So blue chip companies are companies which are financially sound and have a good track record of their dividend and profit earning capacity. Okay, that is big companies with high earning profit and high dividend policies is known as, and a very good financial soundness is known as a blue chip company. Okay, and mostly their shares also cost very high. Okay, they are like premium shares. Okay, so we can take the example of blue chip companies as State Bank of India, Tata, ONGC. These are examples of blue chip companies, and the shares issued by such financially sound big companies is known as blue chip shares. Okay, so the next one is growth shares. Growth shares are issued by growing companies. Okay, and these growing companies are more or less equal to a blue chip company. We can take the example of a Reliance company. We can say it's a growing company. Okay, so these are company which is going on growing, and they invest more in different channels, and they develop their company. So the companies which they develop themselves every year or every time, these are companies which are known as growing company, and shares issued by such a company is known as growth shares. Okay, so the next one is stalwarts. So let's see what is stalwart. Certain companies have the ability to surpass the gross domestic product of a country. Okay, that is they are giant big companies. So shares issued by such a big or a giant company is known as stalwart shares. Okay, so the next one is fast growers. So these are shares issued by fast and aggressive growing companies. Okay, that is these are companies whose profit increase from 20% to 25% within a year. Okay, that is aggressive growth takes place, fast growth takes place. Such companies issue shares, and those type of shares is known as fast growers. Okay, so next one is income shares. So income shares are issued by such company who do not reinvest their profit into their business. Okay, that is they have an stable financial structure, and they do not invest the profit earned again into the business. They just distribute the entire profit as dividend. Okay, such companies issue the income shares. Okay, so income shares are issued by such company who do not reinvest their profit into the business, but instead uh, they just distribute the entire profit as dividend. Okay, so the next one is cyclical share. So let's see what is meant by cyclical shares. The shares value that fluctuate continuously due to cyclical fluctuation of the economy. Those shares are known as cyclical shares. Okay, mostly these are of shipping companies. Shares are known as cyclical shares, as its value changes continuously due to fluctuations in the economic conditions. Okay, so such a shares is known as cyclical share. Next one is slow growers. Slow growers are the shares issued by slow growing company. Okay, they are growing but still at a slow phase. Okay, that is from going to 20 percentage increase in profit to 25 percentage increase in profit. They take some time. They are growing but they grow slowly. So such companies issue shares, and those shares is known as slow growers. Okay, next one is turnaround shares. So turnaround shares are shares of those company who had suffered a lot of losses but is recovering and started earning profit. Okay, so when such company issue shares, those shares are known as turnaround shares. Okay, that is, turnaround shares are shares of those company who incurred a lot of losses in previous times but is now recovering and started coming back to the market and is now started to earn a little profit. Okay, so such shares is known as turnaround shares. Next one is defensive shares. So let's see what is defensive shares. So the shares of companies that produce beverages or medicines or food processing, such companies shares is known as defensive shares. Okay, they don't have a fixed rate of dividend, but their rate, the shares value will be fluctuating, or it is similar to cyclical. So such shares is known as defensive shares. Okay, so defensive shares are shares of those companies which produce food processing or beverages or drugs, etc. Okay, so the next one is speculative shares. So speculative shares are shares of those company which require high knowledge or deep knowledge in the market. Okay, that is, they are a little bit of riskier shares. So one should know about the market condition. One should have knowledge about that company. Then only they can afford that risk or take that risk. Okay, so such shares is known as speculative shares. That is, these shares contain a lot of risk. Okay, so the next one is asset plays. So asset plays are the shares of those company which have a big value on their asset. Okay, so when a company has a big value on their asset and they issue shares, that is known as asset plays. Okay, so today we discussed the types or classification of equity shares. So first one is blue chip equity shares. These are issued by blue chip companies, that is premium companies, and their prices are also very high. Next one is growth shares. Growth shares are issued by growing company or developing companies. And next one is stalwarts. So these are the shares issued by big or giant companies. Okay. Next one is fast growers. So these are fast, aggressive growing companies issuing shares. Next one is income shares. Uh, these are shares of those companies who do not reinvest their profit in the business, but instead they distribute the entire profit as dividend. Okay. Next one is cyclical shares. These are shares of those company whose share value fluctuates time to time. Okay, mainly of a shipping companies. Okay, next one is slow growers. These are companies who grow but they grow very slowly. Next one is turnaround. Turnaround are the shares issued by those companies who had incurred a lot of losses in the previous year but is now recovering and started earning profit. Okay, the next one is defensive shares. So defensive shares are issued by companies such as beverage company, food processing company, or drug producing companies. Next one is speculative shares. Speculative shares are issued by that companies who have a lot of risk, and the persons who have deep knowledge in the market only buys that sort of shares. The next one is asset plays. These are shares issued by companies who has a greater asset value. Okay, so I hope all these classifications are clear to you all. So if you have any doubt in any of this, please put it in the comment section. I will be explaining it once more. Okay, so let's move on to the next type of primary financial instrument, that is preference shares. Okay, So in the previous session, we discussed about the equity shares, and we told that equity shareholders do not have any preferential rights. So preferential shareholders are shareholders who have a preferential right on respect to the payment of their dividend and repayment of the capital. Okay, so these preferential shareholders are paid a fixed dividend, and the after paying these preference shareholders, only equity shareholders are paid. Okay, so they have a fixed rate of dividend, and dividend is paid before the equity shareholders. But the problem is that they don't have any right on managerial decision making or any voting rights. Okay, but there are some classification of preferential shares such as who have voting rights, and there are one type of preferential shares as cumulative preference shares, non-cumulative preference shares. So there are different types of preference shares also. So according to it vary, but mostly preference shares do not carry any voting rights. Okay. So the next one is debentures. As if we have seen the accounts problem, we have always seen that debentures are always given as 10% debenture, 6% debentures. Why such percentage is given before dividend before debentures? But in equity shares and while calculating preference shares, such things are not given. But every time when debenture comes, it comes with the 10 percentage or 20 percentage or 60%. Why? Because debentures are paid interest. Okay, not dividend but are paid interest. Okay, so company issued debenture when it require additional funds, and it is a one way of raising long-term fund. Also, we can say debenture is a loan or borrowed capital of a company, and debentures also don't have any voting right except in exceptional circumstances. That is, in certain circumstances there will be voting right, but generally debentures also don't have any voting rights. Okay, and they have a fixed rate of interest. Here debenture holders are never paid dividend, but they are paid a fixed rate of interest. That is why every time we see the word debenture, it comes with a prefix of 6% or 10% or 12%. Okay, so these interests are paid annually or half yearly, and it is a legal obligation. That is, if the company earns profit or not, the company is responsible to pay the interest rate to the debenture holders. Okay, that is, whether the company is having loss, then also the company will have to pay the debentures their interest rate. Okay, that is a legal obligation. Okay, so that is about debentures. So I told you that the primary market instruments is of four types, that is equity shares, preference shares, debentures and bonds. So the next one is bonds, right? So but I have not added any slides on bond. Why? Because bond and debentures is one and the same. Okay, the only difference is that the Americans call it as a bond and Europeans call it as a debenture. Okay, in India, if these are issued by this instrument is issued by a private company, then it is known as debenture, and if it is issued by a government or a public company, then it is known as bond. Okay, so debenture and bond are one and the same. They have the same features. The only difference is that American call it as a bond and Europeans call it as a debenture. And in case of India, if it is issued by a private company, then it is called debentures, and if it is issued by government, then it is known as bond. Okay, so to compensate that, I am adding a new topic, that is warrant. So let's see what is warrant. So warrant offer the holder the opportunity to purchase a firm's common stock during a specified time period in future at a predetermined price, and this predetermined price is also known as strike price. Okay, so let's understand the warrant better with the help of an example. Okay, so let's say there is a corporation known as ABC Corporation, and it gives the stock warrant holder a contract to purchase 100 shares of companies at 20 per share, $20 per share over the next 10 years. Okay, so the stockholder can purchase the shares of a company, the of ABC company, at $20 over the next 10 years. Okay, and he decided to purchase the 100 shares after 5 years, and after 5 years the share value, the market share value of ABC is $25. But do he have to pay $25? No, he only need to pay $20. Okay, because he had a contract with the company that he can buy 100 shares of that company at $20 per share over the next 10 years. So if the market value of the shares increase also, he do not need to pay that amount. He only need to pay $20. Okay. So such an offer or a instrument is known as warrants. Okay. So today we discussed the major primary market instruments. That is, we discussed about equity shares, preference shares, debentures, bonds, and also about warrants. Okay. So if you have any doubt, you can put it in the comment section, and I will be taking it and I will be explaining it once more. Okay. So if you like the video, give it a big thumbs up and share this channel to all commerce students you know. And if you have not subscribed to the channel, please subscribe to Let's Learn and click the bell icon to get the latest notification as I'm uploading a commerce video on a daily basis. Okay. So for more commerce video, keep watching Let's Learn.